So we have sales consideration of rupees 80,000. Sales consideration is nothing but the sales amount. Hello everyone, I welcome you to my YouTube channel. My name is Muhammad Azhar. So today I am going to teach you income tax management. Tax management 2. Under that we are going to learn capital gain. So we are going to learn capital gain. So what is capital gain? Capital gain is nothing but the transfer or sale of any capital asset. Any capital asset. So any transfer or sale of capital asset during the previous year is taxable under capital gain. So what are capital assets? So I'll turn off the lights. So what are the capital assets? So any property which is held by an assessee. Who is an assessee? One for whom we are going to calculate the income tax for the previous year, right? The capital asset can be a property of any kind related to his business or profession, or may not be. So these capital assets may be movable, immovable, tangible, intangible, fixed or floating. It includes land, building, shares, debentures, jewelries, and so on. Land, building, jewelry. So this is an overview for capital assets. So what is a capital asset? Capital asset is any property held by an assessee. It may be of his business or profession, or may not be. So it may be movable, immovable, tangible or intangible, fixed or floating. I hope you understood till now. There is one more type of assets which is called as financial assets. These are called as financial assets. So assets such as shares, debentures, bonds, mutual funds, UTI units. So these assets are considered as the financial assets in capital gain. So there are two types of capital gain. One is long-term capital gain and another one is short-term capital gain. So we have two types of assets. One is capital asset, another one is financial asset, right? So if any capital asset which is held by an assessee for more than 36 months is considered as a long-term capital gain, and any financial asset which is held more than 12 months by an assessee is considered as a long-term capital gain. So any capital asset which is held less than 36 months will be considered as short-term capital gain, and any financial asset which is held by an assessee for less than 12 months will be considered as short-term capital gain. I hope you have understood till now. Next we will go to the pro forma or format of capital gain, where we will learn how to solve any capital gain problems. Okay, now we will see the format for how to solve the problems for format for computing of capital gain. So there are two types of capital gain, as I said. One is short-term capital gain, another one is long-term capital gain, LTCG, right? So first we will see what is the format for computation of short-term capital gain. So there will be two columns, particulars and amount, right? Amount. Okay, first will be sales consideration. Sales consideration. Here will be the amount minus selling expenses. So if you have any selling expenses, you have to deduct from the sales consideration. So when you deduct selling expenses from sales consideration, you get net sales consideration. Net sales consideration. I will turn off this light. Minus cost of acquisition, that is purchase, minus cost of improvement, minus that is if you have done any improvement for your asset. So we get short-term capital gain, right? So minus, we have some deductions under section 54B, 54D, 54G, which I will tell you later in the problem. So we have to deduct this. So we get taxable short-term capital gain. This is the pro forma for short-term capital gain. Explain you one more time. Computation of short-term capital gain. So it begins with sales consideration minus selling expenses. We get net sales consideration. So deduct cost of acquisition and cost of improvement from net sales consideration. You get short-term capital gain. So in that you have to deduct some deductions under section 54B, 54D, 54G. So you get the final taxable capital gain. I hope you have understood. For pro forma for short-term capital gain, now we will see pro forma for long-term capital gain. So computation of long-term capital gain. Long-term capital gain. So even this is very similar to short-term capital gain with some minor changes. I will tell you what those changes are. We'll begin with sales consideration. Sales consideration amount minus selling expenses. We get what? Net sales consideration. Net sales consideration. So in that we used to deduct cost of acquisition in short-term capital gain, but in long-term capital gain, cost of acquisition will become index cost of acquisition. Index cost of acquisition minus index cost of improvement. So in short-term capital gain it was only cost of acquisition and only cost of improvement, but in long-term capital gain it becomes index cost of acquisition and index cost of improvement. So add this. Now deduct index cost from net sales consideration. We get long-term capital gain. And again deduct deductions. So deductions, we get taxable long-term capital gain. I hope you have understood till now. One more time I will tell you. Sales consideration minus selling expenses, we get net sales consideration. So net sales consideration minus index cost of acquisition and index cost of improvement. So we get long-term capital gain. So we have some deductions under section 54B, D and G. So we get taxable long-term capital gain. So now we have to look what is the difference between cost of acquisition and index cost of acquisition. I will tell you while explaining a problem. You will understand clearly when we do a simple. So computation of long-term capital gain. Long-term capital gain. So even this is very similar to short-term capital gain with some minor changes. I will tell you what those changes are. Okay. We'll begin with sales consideration. Sales consideration amount minus selling expenses. We get what? Net sales consideration. Net sales consideration. So in that we used to deduct cost of acquisition in short-term capital gain, but in long-term capital gain, cost of acquisition will become index cost of acquisition. Index cost of acquisition minus index cost of improvement. So in short-term capital gain it was only cost of acquisition and only cost of improvement, but in long-term capital gain it becomes index cost of acquisition and index cost of improvement. So add this. Now deduct index cost from net sales consideration. We get long-term capital gain. And again deduct deductions. So deductions, we get taxable long-term capital gain. I hope you have understood till now. One more time I will tell you. Sales consideration minus selling expenses, we get net sales consideration. So net sales consideration minus index cost of acquisition and index cost of improvement. So we get long-term capital gain. So we have some deductions under section 54B, D and G. So we get taxable long-term capital gain. So now we have to look what is the difference between cost of acquisition and index cost of acquisition. I will tell you while explaining a problem. You will understand clearly when we do a simple. So here are the formulas for index cost of acquisition and index cost of improvement. For index cost of acquisition, the formula will be cost of acquisition into CII for the year of sales divided by CII for the year of purchase. So similarly, for formula for index cost of improvement will be cost of improvement into CII for the year sales divided by CII for the year purchase. So what is CII? CII is the cost inflation index. CII is the cost inflation index, which shows the inflation rate, the increasing inflation rate for the purchase and sales. So for the years, for the particular year. So this cost inflation index will be given in your questions. They will be mentioning the cost inflation index along with the respective year in your questions. So first let's solve a very basic problem on short-term capital gain. Then we will move on to long-term capital gain. So here will be the question for on your screen. The question will be on your screen right now. Please take down the question. Mr. X purchased a share of rupees 50,000 on 1/4/2019 and he sold for rupees 80,000 on 31/12/2019. Full stop. Commission charges for selling the shares are rupees 2,000. So in this question, Mr. X has purchased a share of rupees 50,000 on 1/4/2019. Then again he sold it for rupees 80,000 on 31/12/2019 with a commission charges of rupees 2,000. So we have to find out whether it is a full long-term capital gain or a short-term capital gain. So whenever you start a problem in capital gain, you have to consider two things. One, you have to check whether it is a capital asset or a financial asset, and two, it is a long-term capital gain or short-term capital gain. So let's see, this is a long capital asset or a financial asset. So the given asset is shares, right? So shares comes under financial assets. So now condition for long-term capital gain and short-term capital gain for financial assets is any financial asset which is more than 12 months with the assessee. So it is long-term capital gain. And if the assessee holds a financial asset less than 12 months, so it is considered as the short-term capital gain. Okay. So now let's see. Mr. X purchased the share of rupees 50,000. Mr. X purchased the share of rupees 50,000 on 1/4/2019 and he sold this share for rupees 80,000 on 31/12/2019 and he incurred a commission charges of rupees 2,000. Alright, so now we have proved that it is a financial asset as it is a share. So now we have to know whether it is a long-term capital gain or a short-term capital gain. So how do we find out? We have to check the difference between the date of purchase, that is 1/4/2019, and the date of sale, that is 31/12/2019. So after how many months has he sold from the date of purchase? So he has sold within the next 6 months, 8 months. In the next 8 months, so he has not completed 12 months. So Mr. X doesn't hold the share for more than 12 months. So this becomes a short-term capital gain. Alright, so this is a financial asset and a short-term capital gain, as Mr. X doesn't hold the shares for more than. Okay, now let's go to the problem. Computation of capital gain of Mr. X for the financial year 2020 and 21. So particulars, amount and amount. So you have to draw this two columns. So what is the first one? We have to check the sales amount, right? Sales consideration. What is the sales consideration? So we have sales consideration of rupees 80,000. Sales consideration is nothing but the sales amount minus selling expenses. So Mr. X has spent rupees 2,000 as commission to sell these shares. So rupees 2,000 to sell the shares for rupees 80,000. So we have to deduct that commission and we get how much? 78,000. So this becomes our net sales consideration. Net sales consideration. So minus cost of acquisition. What is cost of acquisition? Cost of acquisition is nothing but purchase amount. So for short-term capital gain, we don't have to calculate the CII value. CII value will be calculated, the formulas which I taught will be calculated only for long-term capital gain. And as this shares is a financial asset and it is a short-term capital asset, we have to take the amount directly. That is, cost of acquisition is rupees 50,000. Okay, so now minus cost of improvement. So is there any cost of improvement given? No, so it is nil. So we get 50,000. So 78,000 minus 50,000, we get 28,000. So in the questions, no deductions are given. So 28,000 will become our taxable short-term capital gain because no deductions are given. I hope you have understood a simple problem on short-term capital gain. So first you need to find out whether it is a capital asset or a financial asset. Then you have to check whether it is a long-term capital gain or a short-term capital gain. And after knowing it is a financial or capital asset and long-term gain or capital gain, then you start your problem. So problems on long-term capital gain we will try to solve in the next class. And I hope you have understood till now. If you have any doubts, please do let me know in the comment box and please subscribe my YouTube channel. Thank you.